Russell, we've seen that there are big new changes happening in the Nigerian tax landscape. Can you set the scene in terms of, first of all, why all of these changes have been happening so suddenly? And secondly, when are we expecting to see them come into force?
Right. Well, yeah, it is a big lot of changes, and I'll come back with a bit of background on that. The easier question is when it's coming into force. Implementation date 1st of January 2026, which gives a little bit of time, which in some cases will be useful. There was some concern about the Administration Act. That's been resolved. I heard a rumour yesterday that the gazetted version was incorrect, and it should have been gazetted with an effective date 1 Jan. So that's the easy part. Why is it happening now? Why is it sudden? Well, it's been building up for a while. I think it's been long recognised that the Nigerian tax system was inadequate and inappropriate in many, many ways. I'm not going to bore people with all that. The last government had a programme of trying to improve that. I was actually part of that. I'm sitting on a committee. We didn't achieve that much, and everything gets bogged down in politics. The current government appointed a former colleague of mine as chairman of a special committee and gave him a bit more power. So they've come up with a lot of changes. I think what they've seen in the last bit, a lot easier to identify the problems and the corrections required than to get them through the parliamentary process, which has been a challenge. But they've achieved a lot. So that's what it is. And I think, from inconsistencies in the Act to just not making enough revenue to not working out which government gets it, a thing called a value-added tax, which was not a VAT as anybody normally would recognise it. A lot of needs for change, and this has addressed a lot of them. A couple of last-minute changes which seem to have diluted some of the effects. I think it's gone from being friendly to both government and business to largely being friendly to government.
Yeah, that's often the worry we have with new tax regimes. So it sounds, Russell, that these big changes aren't as a result of a particular structure the government is trying to attack or any specific changes. It's rather a long-awaited tidy up of the full tax system.
A big reform, I think, is long awaited, long needed. Not everything's going to be welcome. In fact, quite a lot of things won't be. But the chairman of that committee, he had a thing when it comes to individual tax that the state governments have got to get away from taxing poverty and taxing richer people, which is quite a big mindset shift for them. So yes, no particular structures. There may be a couple along the way that have been either targeted or collateral damage. An example was the moratorium loan. Foreign lender to a Nigerian business, if he satisfied some conditions about the length of the loan and the terms on how long it had to stay in existence and not requiring debt repayments for a first little period, then you could have a reduced rate of withholding tax. That's all gone.
Okay, so we will go into more detail as we progress, but could you give us a couple of bullets on what are the main changes multinationals with subsidiaries in Nigeria need to be aware of?
Right, from a business point of view, I think the first most obvious one is probably the VAT. As I said earlier, Nigeria's long had a value-added tax act, but in my mind, it's never had a value-added tax. It had a sales tax masquerading under a VAT. Now this is going to change to a proper VAT. Big change. That will require a lot of system changes because now you're going to be able to recover your input tax, even if you're not selling stuff you made or bought. So that's going to have a lot of system requirements and documentation requirements and things to get used to. On the other hand, it does help bring the effective VAT down. You won't have the same cascading problems. The only companies that are outside of that are people selling or exporting crude oil and certain types of gas feedstock, and they'll be exempt from that. So that's a nuisance. Likewise, banks are going to be, as they are in most countries, in the partially exempt system. So they're going to have to start working out how they're going to claim. And we're waiting for some detailed explanation of the VAT law from the tax authority. So that's the one big one that I think is going to affect an awful lot of companies. The corporate tax rate's going up ever so slightly, but a little bit simpler. So instead of having 3 or 4 different income taxes coming to somewhere between 33 and 34%, you're going to have 2 taxes. Still one too many. And it'll be 34%. Capital gains goes from 10% capital gains tax rate to the income tax rate, which is not so very welcome. And foreign assets will be taxed. There's a quite complicated, in my opinion, badly written section on indirect disposals. So there you are, thinking you're going to sell your Nigerian subsidiary by selling the company above it in a foreign country, and the Nigerians say, well, we'll tax that anyway. That's a fairly big change. For multinationals, there are a couple of things on it. Yeah, if you've got expatriates in the country, their tax obligations are going to change. They may want some compensation for that. Depends on people's bargaining power, I think. What other big changes for companies? Quite a big change on double tax relief, which will impact some people. If you've got a company with foreign income, then previously you couldn't do much with a double tax credit unless it was coming from a Commonwealth country, and then you got half the tax back or something ridiculous. Now it's been simplified to get any foreign tax back, subject to normal restrictions. For bigger companies, there is a top-up tax, and it has two guises, one of which affects Nigerians investing out, and the other one of it, in fact, affects any Nigerian company, including one held by foreign owners. If it's got a 20 billion naira turnover, which is a lot lower than the 750 million euro threshold we're familiar with, then it'll have a tax up to the minimum tax rate of 15%. Certain carve-outs for people in the free trade zones, which are time limited. But broadly speaking, it's going to be that 15% minimum tax.
Okay, so that's a lot of changes we're seeing. So where a Nigerian holds subsidiaries in low tax jurisdictions, there will be a top-up tax. It sounds like the corporate tax rate won't change much in practice. It's just the way it's being levied. But this new indirect capital gains tax is going to hit people unexpectedly.
Yeah, I'd say that's true. And part of me says, if you were thinking about selling, it might be good if you can do it to sell before January.
Before January.
But then you got the Competition Commission, the Federal Competition and Commission.
Yeah.
So you need permission. You're unlikely to get that in time. But there's a few things where structuring before the 1st of January may be a good strategy.
Okay, and what about withholding tax? We know all African countries love withholding tax. Has there been changes to the WHT regime?
Well, the good and bad news on that. The good news is not in this law. The bad news is there were a load of changes already back in January 25, and we have talked about that extensively in the past. They did make quite a lot of changes, but at least there's been no more changes. So if you're already familiar with the January 25 changes, then you should be comfortable to keep on going.
Okay.
Nigeria loves withholding taxes like most countries in Africa, and love tripping people up with it.
Okay, and are there any new compliance or reporting requirements that will impact Nigerian entities?
Yeah, I think there's a couple. One, they've taken a distaste for what they call virtual asset service providers, VASPs. So if you're selling or buying virtual assets or running a platform to do so, or custodian or any of those sort of things, then you're called a VASP and you must register, and you've got a load of reporting requirements. Yeah, that they still haven't finalized exactly which body is going to do that, but that's going to be there.
And Russell, does that include cryptocurrency?
Yeah, particularly includes cryptocurrency.
So that's kind of what they're targeting. Okay, so big new regulations.
Probably comes back to the fight they had with Binance. Yeah, so that is big new regulations for them. I think any Nigerian company who's got assets outside, any Nigerian person who's got assets outside, is going to find an awful lot more compliance to be doing and thinking. There are certain carve-outs, but broadly speaking, there's some interesting control foreign company rules. There's a lot of new rules on residence of a company. In the past, to be a Nigerian company, you had to be incorporated there. Now, there's a management test. And that's sufficient to bring you into the Nigerian tax net. And that will be a big new paradigm shift, I think, for Nigerians who own foreign companies.
Wow.
I think even at individual level, I'm expecting the state tax authorities to have to change their forms significantly to get more information about foreign assets, foreign income. There's certain exemptions, but we'll see if people qualify for them. So I think an awful lot of change in the way the compliance process is approached. There are, the capital allowances regime is changing, probably for simpler, but that'll change things a bit. There's an unfortunate problem for anybody with the pioneer status, which is the tax holiday, the 5-year tax holiday program that was quite widely used. That's being abolished, but anybody who's got it currently will continue to cap it. And it's being replaced by a new scheme, which won't be a tax holiday, gives you a tax credit equal to the tax you would have paid. So effectively in and out. So it's like a tax holiday, but not called one, presumably to keep the pillar two countries happy.
Yeah.
But that one is protected from the minimum tax, the top-up tax rule. The people who've got pioneer status will not be protected and therefore will be subject to the 15% top-up tax. So yeah, pioneers becoming less beneficial than it was.
Okay, interesting. So what strikes me is that there's actually a lot of rules designed to target Nigerian businesses with offshore structures.
Yeah, I think that's about the size of it. I think it was always seen as a bit lopsided that you were better off investing your money outside Nigeria than in it, which is not good for the country.
Okay. And have there been any changes to the transfer pricing regulations or documentation requirements?
No, I don't believe there has. Certainly not in the requirements. I think they're still there. They're still being policed reasonably efficiently, effectively, and bureaucratically perhaps. But there's no new change. It's just it continues there. I think what might happen is more companies being drawn into the net of who is a Nigerian company can have an effect on more companies
through the residence, the new residence test.
Yeah.
Interesting. Okay. And is the residence test based on place effective management similar to the OECD and South African regs?
Well, it's a very curious thing because it starts with incorporation, which is normal. Then it goes into a POEM test, but it also goes into a CMC test, a control test. So it's a little bit wordy. Yeah, broadly, the effectiveness is it's got a residence test on top of an incorporation test. And
okay. Yeah, I think that may have quite a lot of effect.
Yeah.
And Russell, can you talk us through the changes that could apply for expatriate employees sent to Nigeria?
Yeah, I think the starting one is the tax rate. So previously, if you read the law very carefully, you'd find out the top tax rate was about 19.2%, there or thereabouts. People come up with different numbers and perhaps reduce slightly to 19%. The new tax rate is going to be 25% maximum rate, graduated. So I think it only hits that at about 50 million naira of income, but 25%, and on global income. Whilst in the past, it was effectively on Nigerian income. Now, when it comes to investment income, there may be a way around it, but it's not a very attractive one because there seems to be a carve out for people who bring investment income, passive income into Nigeria through official channels. Now, most expats don't want their foreign income coming anywhere near Nigeria. And therefore, they may need to think, well, how do I avoid having the income? Or how do I bring it into Nigeria, perhaps put it in a domiciliary US dollar account and then take it out again and hope the central bank doesn't suddenly change the rules to lock it in the country?
But that is quite a big impact if Nigeria is now trying to tax the worldwide income of expatriates, especially because Nigeria doesn't have a lot of double taxation agreements. So we wouldn't be able to rely on the tiebreaker for residents. So that's certainly something that people with expatriates in Nigeria should be aware of.
I think, yeah, for those who've got expats or those who are trying to send a new expat there, I think they will need to be aware of it. It may come into the pricing of the remuneration or seeing what can be done to restructure affairs. Otherwise, you may get the position where people either get caught out by a bill they weren't expecting or that they say, well, I'm not going to go.
Yeah. Yeah, interesting. And have there been any changes to the penalties or other enforcement mechanisms for non-compliance?
Well, there's a few. There's a lot more penalties as the start. There have been even penalties. And there is one which I think has been reworded because previously the penalty for not getting your tax right was 10%, broadly speaking, and that wasn't much of a penalty. Now there's one that says if you've not self-disclosed your taxes, then there's a penalty of 50% on conviction, or 3 years in the prison, or both, and that's a lot more serious. And there's a further provision that says that the tax authority can choose to compound an offence by accepting a cash settlement. So it doesn't have to the court and get you convicted. So it becomes a much simpler thing for them to take a severe penalty against the taxpayer.
Yes.
And they're just often to do it. There's a couple of other odd provisions which Nigerians may accuse me of talking English here and looking at the wording of the law, not reality. But there's a penalty against being a corrupt tax official, demanding or receiving a bribe or not probably accounting for the money, and another one for bribing or attempting to bribe a tax official. So those could all taken together, and it will require a lot of changes in the tax authority's modus operandi and approach to things, but taken together, I think that could lead to a lot more efficient action against taxpayers, a lot less informal methods of resolving problems against the interests of the government, and a lot more severe approaches to taxpayers and the need to get things right.
Well, that's good news, and definitely does sound like real efforts to tidy up the tax framework.
Yes, I think so. So a lot to get used to, but there's a lot of interesting things there. And Nigeria recognises its tax to GDP ratio is unsupportably low.
Yeah.
This will bring a change. There's one change that it's always worth mentioning it, and that's on. And I think about the social contract is what triggered it. In that, from going from a position at the start of this government of subsidising the petrol price, there will now be a 5% tax on liquid fuels.
Wow, that's quite a U-turn.
Nice anonymous name, a surcharge, but it's actually a fuel tax.
Okay, interesting. So from subsidy to plus 5%.
Yep. Yeah.
And Russell, can you talk us through any changes to the various incentives and tax holidays that we've seen applying in Nigeria?
Yeah, I think the two big ones are the pioneer status, which I mentioned earlier, being replaced by the economic development incentive. So moving from a tax holiday to a tax credit system, and some of the ancillary benefits of being able to distribute profits free of withholding tax, they'll disappear. And that one, taken into account also the minimum tax, is a big change. And then putting in some sunsets on that, so it really does incentivize industries that aren't developed rather than people who weren't industries that weren't developed 30 or 40 years ago. The other one is the free trade zones or export processing zones, and there's been some abuse of those, I would say, and that's being tightened so that if you don't export at least 75% of your product out of Nigeria, not into the customs territory, but to foreign countries, real foreign countries, then you won't qualify for the tax exemption. If you do qualify for the tax exemption, it's got a sunset clause on it, which the president can extend, but it's still got a backstop extension limitation on it. And thirdly, the impact of the top-up tax has to be taken into account. That will come and bite people. So I think that was all designed to try to restrict the use of that and try and make it much more focused. I think that's probably some pressure has been put on the government by external advisors over the years come to bear. So those are the main ones I could see. They said the first year allowance for capital allowances that was abolished. So the capital allowance is now a straight line over relatively easier periods to work out. What else? Been some tinkering with the mine rehabilitation provisions, which probably make it a bit easier to use, I think. But I would say that not an awful lot of stuff on the incentives in this. It's perhaps more designed to try and bring money in than to send it out.
Yeah. And have there been any changes in interpretation or any discussion that could impact the application of double taxation treaties that Nigeria is a party to?
Nothing new. I think what we've got is a great deal of bureaucracy that comes from the Federal Tax Authority, where if you want to take advantage of a DTA, for example, an exemption or more particularly a lower rate, then you must apply for that benefit, and that remains largely through practice. So you must then get a form of certificate of residence from your country and perhaps another one from the tax authority itself, and then sit and wait. So that's a nuisance. I don't think there's been too much other change, and Nigeria's not been rushing around entering in or ratifying any treaties. It's been entering into them, never getting around to ratifying them. Mauritius was a case in point, but even the UAE and Qatar just seem to be stuck.
And Russell, how many enforced treaties does Nigeria have currently?
I know, I can't remember offhand, but
okay, don't
not that.
Okay,
it's probably less than a dozen. It's got with some of the bigger countries, the UK, Netherlands, France, South Africa, Singapore, funny enough, and a few countries that don't get an awful lot of use, like the Czech and Slovak republics and things. But and there is one now with the ECOWAS member states, the local trade body.
And Russell, what would you say is the key actions a multinational with a subsidiary in Nigeria should be considering?
Right, I think that look at their structure, the ownership structure. If you've got a complicated ownership structure to try and reduce CTT risk in future, is it still necessary? Is it still useful? If you're using certain tax incentives to reduce your tax rate. Are they still going to work? And cost that in. Yeah, do a bit of budgeting about the new tax rate, even the new capital allowances rates, and see what they do to you. And make sure you get the VAT implemented. That's a reasonably good, clear one. Yeah, watch out for the things on the personal income tax rates for your staff. For a lot of the staff, it'd be beneficial. Just trying to think what the other ones were I had there in my mind. Yes, as I say, if you're getting a low tax rate through incentives, then I think really go out and see if that's going to continue to apply. And think in your structuring if there's anything you need to do to make it more effective under the new law before January. This would be a good time to think that through and maybe do things that you need doing. Yeah, there was something there. We were expecting to see a stamp duty on sale of shares. That's it's in the schedule, it's there, but it's another section saying there's still no stamp duty on transfers of shares, so that's probably a good thing. Yeah, the reorganizations, if you're going to do a reorganization that could lead to a tax bill, then there's more useful provisions coming into force in January. So it may even be useful in certain cases to wait rather than to be jumping into a transaction because the current laws require a 12-month common holding period between the two companies involved, and that's going.
Thanks. So Russell, if you're a Nigerian business owner with international operations, what would you say are the key areas you need to look at?
I think then it comes down to what's the effect of this stuff on residents going to be, and how do I create a preemptive argument, a defense argument against my foreign subsidiaries being managed in Nigeria. Probably not too important where they're high tax countries, but is important where they're low tax. How do I then make sure the CFC rule doesn't apply? So I can then show if there is distributable profit that would cause a tax problem in Nigeria, then I can show I wouldn't have been able to have declared that dividend without detriment, to create another defense document. Model the tax rate, I think, is still important. I think if my structure is appropriate, should I be thinking about selling some of the foreign assets into an offshore structure if I'm a privately owned business, and think about my own personal affairs generally if I'm the private owner of a private business. There are a couple of other incentives that are useful. Think about whether you can use them. Are you exporting goods and services? If so, that could be useful. You'd still be subject to the top-up tax if you're above the 20 billion turnover, but 15% beats 34. So that can still be useful. So I think it really is a matter, and again, the VAT, you've got to get the VAT right. So I think those are the main things. Looking back through it all, getting familiar with the changes, not hiding from it, realizing they are real, and the tax authorities will at some stage start applying them. I think the final point is, even beyond being familiar with the new law, becoming familiar with all the law is probably a good idea. I think we will see an increased efforts by the tax authorities to enforce compliance.
This CFC rule, is this a new piece of legislation in Nigeria? And can you talk through how the CFC rules work?
Yeah, the CFC rule is entirely new. And what it says is if you've got a company controlled by a Nigerian company, a foreign company controlled by a Nigerian company, and it had distributable reserves, which it could have distributed without detriment to its business, then it will be deemed to have done so, which means the foreign dividend is then taxable in Nigeria.
Yeah. Does it also apply if an individual holds a foreign company?
It does not, but there's a separate section that deals with that scenario in some cases. And if it's owned or controlled by 5 or fewer persons, then it can also have this test of could you have distributed without detriment to your business. Now, for an individual bringing a dividend back in, a real dividend, then there's an exemption. Not for a company, but for if you've got a constructive dividend, a deemed dividend, then that doesn't qualify for exemption. There's a funny mismatch, therefore, between this exemption and the CFC or closed company rules.
So in other words, if an individual has a foreign subsidiary and receives a dividend, it would be exempt. But if it doesn't receive the dividend and is deemed that it could have received the dividend, then it will be taxable.
That appears to be the case, which is a bit strange.
Interesting. And Russell, the Pillar 2 top-up rules, has Nigeria brought in a defensive Pillar 2 position, whereby if the foreign parent will charge 15%, they'll increase the rate?
Not in so many words, and Nigeria has kept itself out of the Pillar 2, Pillar 1 discussions and said it doesn't agree with it. But they brought in this top-up tax, which kind of is a defensive mechanism, but it applies to a much lower threshold. So any Nigerian company that is that has a turnover of 20 billion naira or more that didn't pay a 15% tax rate will have to pay a 15% tax rate. So I think that it doesn't use the OECD terminology very well. It's a much lower threshold. It's probably a bit cruder. So yes, there's some mechanics in the working out of what the profit and the tax rate is, but it broadly comes to a 15% top-up tax, which will affect not only those subject to the income inclusion rule in other countries, but to anything.
And you mentioned 50 billion naira. What's that say in US dollars, roughly?
Divide by about 1,500. So
very low number.
20 billion is about $13,000.
Yeah. Okay. Wow.
Yeah. So it's going to affect a lot of companies.
Yeah.
Yeah. The other
Great.
thing on defence, and it is getting to grips with the law early. There may be times when a real dividend now may be more beneficial than waiting till after January. On certain other real transactions. So there may be, because we've got that few months gap now between now and implementation date, there could be a window of opportunity to do something that will make life easier later.
Thanks, Russell. So all in all, it sounds like a lot of changes that are both going to impact inbound and outbound Nigerian businesses, and it sounds like there are some potential opportunities that could be used over the next few months to delay or to avoid the impact of the new taxes.
That's about the size of it. Yep, but it's going to take a job of work to get familiar with all the changes that can impact your business or your own personal affairs, and see how the effect is. And then sometimes it's a matter of crying, and sometimes a matter of seeing what you can do to reduce the pain.
Great. Thank you, Russell, for that nice, short, sharp summary.
Well, very welcome. Pleasure to talk.